Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Honestly, a lot of the focus is going to be on the Apple Intelligence AI features. But the question is, how does it get implemented? What's it like to use? Does Siri actually become smart? Apple has said, look, if you want to use these new capabilities, you're going to either have to have an iPhone 15 from last year or the new iPhone 16.
First of all, the economy is basically doing okay. It's slowing down, but I don't see a recession in the immediate future. And second of all, even though the market is going back and forth on how big the rate cuts are, the fact of the matter is we're going to see one.
At the end of the day, if Google is found to be an unlawful monopolist, one of the remedies that the government will seek will be some kind of divestiture. Now, so much has happened since then. The companies that were divested are not the same as that part of Google now. But one can imagine some form of divestiture, which would be simply a part of the remedies that the government will seek.
Well, we've got 1 hour to go until the market closes. So let's take a look at the major averages sponsored by Tasty Trade. And we've got a rebound going on today, Josh. Last week was a terrible week for the major averages, particularly if you look at the S&P 500, it was down more than 4%. I was looking at some stats from Bespoke Investment Group, and they said if you go all the way back to 1953, that was the worst first week of September for the S&P 500 in that whole period of time. So it didn't just feel pretty bad, it was pretty bad if you look at it on a historical basis. So we're coming back today, but not making up for those losses, obviously. Up 1% on the Dow, up nearly 1%, 0.9% on the S&P, and up about 0.2% on the Nasdaq.
I like how technicians at Piper put it to their clients today, Julie. They said, equity investors are walking a sentiment tightrope. That's what they say. They said, Fed rate cut cheers. Got recession fears, you got a political wonderland in their words, there's a lot going on. I did think, now they're chartists obviously, and I did think, how they put it was, they actually saw last week's weakness as just a pullback, in their opinion, in the context of a larger uptrend. We'll see.
Interesting. So let's look at a 1 month then for the S&P 500. And you see we've come kind of round trip, I guess, to where we were. I did want to check on what we're seeing sector-wise for the S&P also, because it's a pretty broad-based gain that we're seeing today, even though it's not huge magnitude. It's, healthy magnitude. We got financials, industrials, and energy that are doing the best. And now, what's going to be the next catalyst? We might have to wait till the Fed decision, which comes next Wednesday, not this Wednesday, next Wednesday. This Wednesday, we got CPI, but CPI feels a lot less relevant now.
Yeah, not what the street is really focused on at this point. I mean, the street's really turned to the economy, the labor market cooling. Is it just cooling or the start of something worse? And that's being debated. We saw Apollo's Torsten Slok, we both know and like very much. Torsten over the weekend, it was interesting, Julie, he looked at all the data and said, this is a soft landing. The U.S. economy is not in recession. He doesn't see signs of recession on the horizon, but we have some very smart strategists we'll chew that over with today.
Yes, we will. And then finally, we wanted to mention what's going on with the S&P 500, of course. There were some changes that were announced. They don't take effect until September 23rd before the market open, but you tend to see stocks move in advance of those kinds of changes. Most impactfully, probably here, Palantir, Dell, and a company called Erie Indemnity, which is an insurer. It was announced that all three of these are going into the S&P 500. Palantir getting the biggest boost from this, up 13.5%. Dell up 4%. Erie Indemnity up a little more than 1%.
We saw Dan Ives over at Wedbush. We know Dan very well. Long-term Palantir bull said, told his clients this was a validation moment for the Palantir story, Julie. So you could see that stock popping. And we have Palantir's Matt Babin, head of energy and natural resources, coming on the show later because they made some news there too.
Just one more quick note. The companies that are coming out of the S&P 500, American Airlines, Etsy, and Bio-Rad Laboratories, not really seeing that much of a, with the exception of Bio-Rad, not seeing that much of a
pretty
negative
modest
effect
right now.
there. Yeah.
All right, well, moving on here. Apple's product event shining a spotlight on the tech giant's latest innovations. Apple revealing its latest AirPods revamp, new Apple Watch models, and of course, an all-new iPhone. CEO Tim Cook pointing to the AI capabilities for the iPhone 16.
The next generation of iPhone has been designed for Apple Intelligence from the ground up. It marks the beginning of an exciting new era.
Well, for more on Apple's fresh batch of product announcements, we've got Creative Strategy CEO and Principal Analyst Ben Beharin. Ben, it is great to have you on the show. You know, big question for investors, of course, Ben. You know, this new iPhone 16 is going to spark a meaningful iPhone upgrade cycle. Last time we talked to you, Ben, you said you did expect this to have, I think you said a stronger than normal refresh cycle. I believe that's how you framed it, which should sound, relatively bullish. Now that we officially have the news, Ben, you sticking with that view?
Yeah, and I think I want to continue to temper, as I've been largely like, we don't think super cycle because there was dynamics that led to the last super cycle, which I don't think are repeated here. But that being said, I do think that there's so much evidence that Apple has a very, very aging installed base, a good portion of the base going back to even just iPhone 12 and beyond. So you have to imagine that a lot of those folks are just up against their upgrade cycle. And so I look at this within that lens of a huge portion of their base with aging devices, looking and trying to be enticed, right, to buy. And I think they did a really good job with this lineup. In fact, I actually think that the base iPhone 16 is probably the best base iPhone they've ever made, which could actually very interestingly lead to a stronger cycle for the base model, where we've actually noticed a mix shift the last couple of years to the Pro. And I think if that happens, if this aging base does more opt for iPhone 16, we might see more of that mix shift either go toward iPhone 16, which again is not something we've seen before, and we'll see a stronger sales cycle for that, which again might impact ASPs slightly. But I do think there's a lot of optimism and a lot of stuff to increase and entice upgraders to the base level i16 just because of how good that product is.
Interesting. We were showing some of the demo of that. By the way, I like the contrast between Tim Cook standing in front of a big screen of an outdoor scene, and you actually outdoors in front of real trees. Those are not AI trees behind you, Ben Beharin. But that brings up AI, and we are seeing the stock at the lows of the session. The company said it wasn't coming out with any new Apple Intelligence features today that we didn't know about already. It wasn't really expected that they would, was it? Or were you looking for a little bit more on that front?
I mean, I do think there's a couple things, right? With the iPhone 16 lineup, they do have this feature called visual intelligence, which basically lets you use the camera to take a picture of any object, and then it will go and get that information about what that is. That's useful. I think that's coming only to the iPhone 16 models and beyond. So there is that one thing that sort of sets it apart. But other than that, the vast majority of Apple Intelligence experiences will come to iPhone 15 and later. And we know that that's coming out in a open beta to everyone in October, and then more of those features like Genmoji and a whole host of other things coming out later on or early into next year. So all of that I think is relevant to two things. One, I think there's just a lot of people who do need to upgrade. I think the hardware will entice them. I think the carrier promotions will entice them, with the hope that Apple Intelligence continues to be very, very interesting and help sell this cycle and strengthen this cycle over time. But I'm not sure that's going to be the immediate rush, just again, because we don't know when many of these new features are coming out. And I think it's just still going to be a hardware rush, which is why I say very, very compelling in just the base hardware capabilities of iPhone 16 to entice those upgraders.
Ben, I'm curious because you do a lot of important survey work. Why typically do people decide to upgrade? What's the reason? Is it battery? Is it camera, design changes, all three?
Yeah, so it's a great question, Josh. I mean, we have always a list of options in our surveys, and one of them is just it's old and slow. And it would not shock you that is the predominant reason that people choose, is that it just feels old and slow. And I think, when you just look at how good phones have gotten the last few years, that they last a really long time. We're using premium components, particularly Apple. The silicon can sustain a long period of OS updates, so they hasn't felt the need to really upgrade. In fact, I talked about this maybe even with you years ago, just the idea that because Apple silicon is so good, it actually elongates this cycle because it performs so well for longer. And that's just led to people just saying, hey, I don't have a reason to upgrade yet. I'm okay with what I have. And so I do think we're really up at that edge. In fact, I think we're up at that edge probably more so than we've really ever been in the last couple of years, which is, again, why I'm a little bit more optimistic to this cycle. But again, I think that benefits the iPhone 16 more than the Pro, which is not something we would have talked about in last, fall quarter upgrade cycles.
Ben, it's funny because at one point, there were complaints that Apple sort of timed it, that the stuff would wear out on a cadence so that you would need to get new ones. But this does also raise the question of if the real advance here is going to be more software-based than hardware-based in terms of AI in the phone, what is the next big hardware change? I mean, you look at Huawei, which is coming out with a Z Fold phone today that, I guess, folds sort of like an accordion, and they've got 3 million pre-orders for that thing. Is that the next thing we should be looking to?
Yeah, I mean, it's tough because folding phones just still have a lot of durability issues. We're getting closer to solving those, and I think Apple just takes the conservative approach. I think it's hard because we're sort of out of the era where we're just, amazed by hardware wizardry. I do think folding phones will make a very interesting addition to this lineup. I don't expect it anytime soon. And I think because of that, that's why we're leaning more towards software and the ingredient that is AI to enable some of these features that we hope people view solve some pain points and adds usefulness to their life, because we're just squarely in a very software cycle right now with just the hard challenge of year over year hardware innovation just getting more difficult. But I'm as optimistic as any in foldables. Again, we don't see those sales in mass quantities. And so I don't think it's something that Apple's on the immediate horizon on, but that certainly is an interesting form factor change that we could see in the next couple of years, get more traction. But again, we're not seeing volume in those sales categories yet.
Ben, it wasn't just iPhone today, of course. It was AirPods, it was watch. Wearables, really important part of this company's story now. What stood out to you there, Ben?
Yeah, so I would say, again, from a financial standpoint, I would be watching very closely this segment category, because it does seem that, again, Apple knows there's a lot of people with very old AirPods and very old Apple Watches who, again, haven't upgraded. And I think that we may see a very strong upgrade cycle for AirPods across the board. Obviously, AirPods 4, new redesign, an option including with active noise canceling. You've got some of the hearing aid functions that I actually think is going to be very, very interesting to a lot of people, particularly in AirPods Pro, and just the new design of Series 10 getting larger, even a slightly larger display than Apple Watch, I think will be super compelling. So I would expect a much stronger than anticipated upgrade cycle for the category of wearables for Apple, given what I saw product-wise today.
All right, we'll be watching those numbers when they do start to come in. Ben Beharin, great to see you. Thanks so much for joining us.
Yes, thanks for having me. Anytime.
We're just getting started here on Market Domination. Coming up, Yahoo Finance is out in San Francisco this week for the Goldman Sachs 2024 Communacopia and Technology Conference. We'll have CEOs from Mattel, AMD, and AWS who will be joining our program throughout the day. Plus, shares of JetBlue. They're flying higher on the back of an upgrade. We'll check in on some of the top calls of the day later in the hour. And then at 4 p.m., Oracle will be releasing their first quarter earnings report. We'll get to the latest from the tech giant as soon as those cross the wire. All that and more when Market Domination returns. Now it's time for some of today's top trending tickers. And we should note throughout the trading day, you can track the best and worst performing stocks of the session on Yahoo Finance's trending ticker page. That's the one that we watch very closely. You can scan the QR code below in order to check them out. And right now, a couple of those tickers, we're looking at shares of Summit Therapeutics and Merck. Now, Summit released trial data on its lung cancer treatment that shows more encouraging results compared to Merck's cancer drug. Why is this important? Well, it's important for each of these companies in some pretty unique ways. First of all, Summit doesn't have an approved drug. The company doesn't have any revenue, but its shares have been soaring this year in anticipation that this drug might be approved. And on the flip side, Merck's Keytruda, its lung cancer drug, is its top-selling product by a long shot. It makes up about 40% of the company's revenue.
That's the blockbuster.
Yeah.
Yeah. I reached out, so the team at Stifel, I reached out to them because I know they cover Summit. They were telling their clients they have a buy on Summit. They did raise their price target to 25, up from 14, so that's a nice bump. Say the company is looking at a total addressable market of about $50 billion and still growing. Upside potential significant, Julie.
And by the way, they developed this drug in cooperation with a company called Akeso or Kesso, which is a foreign company. But the shares were already up like 370% year to date before today, before the increase today. But again, it's one of these pre-revenue companies that's been waiting for this drug to come out. Merck's shares, by contrast, are up something like 6% this year. It's sort of been muddling along. By the way, it is going to lose patent protection for Keytruda in 2028.
All right, moving along. Turning to cannabis industry, those stocks getting a lift after former President Trump voices support for marijuana legalization in Florida. So Trump suggesting on his Truth Social platform, Julie, that he supports, I guess, a ballot referendum in Florida that would allow adults 21 and older to use cannabis, also supports assigning cannabis to Schedule 3 under the U.S. Controlled Substances Act, currently listed as Schedule 1, as we know.
Yes, and so to be clear, he is supporting this amendment in Florida as a voter, because he is a Florida voter. And this is something that Governor Ron DeSantis has not been supportive of, by the way, that adult legalization, recreational legalization in Florida. So interesting that Trump's on the opposite side of him. But you know who he's on the same side with this kind of stuff is the Democrats, largely, and Kamala Harris, who have been amenable to the rescheduling of cannabis on the federal level. He also mentions safe banking authorization, which is something that has been trying to make its way through Congress for quite some time. So it's significant that he is saying this, but it's also significant that sort of both sides now, there is more consensus perhaps on some of these changes. And by the way, marijuana stocks, they've been kind of all over the place, but they haven't done great this year. Usually I look at the MJ ETF, the Alternative Harvest ETF, as sort of a proxy for the industry. It's up this year, but not up a lot. It's missing. It is underperforming the market, I should say.
Yeah, it was, obviously election, Florida front and center. I was reading that the state's cannabis referendum that we were just talking about, polling with more than 60% support. So if you're a politician, who wants to get on the wrong side of that?
Yeah, most definitely. Well, this week, Goldman Sachs is holding its 2024 Communicopia and Technology Conference in San Francisco. It's hosting some of the top executives in business, tech, and more. And Yahoo Finance's executive editor, Brian Sozzi, is there to cover it all. And he's with us now. Hey, Soz.
Hey, Julie. What's cracking over there? Yeah, well, lots of AI focus there here at the Goldman Sachs Communicopia Conference. But right now we're going to talk some toys because there is a tech story inside the toy industry as well. Mattel Chair and CEO Anand Kraz. And Anand, good to see you as always. So, obviously this conference is very focused on tech. How do you see AI impacting the business of toys?
So at Mattel, we continue to innovate and bring creativity into everything we do. And on that note, of course, AI and technology will play a key role in how we continue to evolve what we do. At the core, Mattel is a creative company driven by innovation. And we see AI as a tool, as an opportunity to elevate our creativity even more than we have done in the past. We already started to play with and implement some AI technology into prior games, and you will see more of that coming in the future.
Will AI help you get new toys to market even faster and even cheaper than you ever have before?
Well, AI can play a role in multiple ways. It's about the process itself. How do you achieve efficiency, reduce time to market, and optimize what you do? It's about cost optimization, and ultimately will also be about integrating into product, but it's a bit early to talk about how we are looking to do it now.
Your largest competitor has made a hard pivot into games, really hard pivot into games. And I think in their most recent quarter, their inventory was down 51%. And I think some are trying to figure out, what does that company look like? I mean, where is your focus over the next 12 to 18 months? And you're not focused on games, but where is your biggest areas of opportunities?
Well, Mattel is a toy and family entertainment company. And our business model is about continue to grow our IP-driven toy business and at the same time expand our entertainment offering. We see significant value that we can create in the toy aisle given the strength of our brands and the quality of our product, and how we continue to improve profitability, higher gross margin, lower cost, more market share. And lastly, we had the highest share gain in our history in the US. So we continue to perform very strongly within the toy side of the business. And in addition, we continue to grow and expand our offering outside of the toy aisle. And for us, this is about content, film and television, location-based entertainment, consumer product and merchandise, and very importantly, digital as well. And we talked about the fact that we're now looking to get into self-publishing of mobile games. It's a very exciting part of the industry that we believe we can apply our IP and execute well at a very favorable risk-return profile for Mattel. We continue to see Mattel 163 continuing to grow at more than $200 million at very high margin. This is a 50-50 joint venture that we own today based on 3 games only. So we know our brands resonate not just in movies that we've already shown, but also in games, in mobile games specifically.
Are the biggest toy makers, of course, obviously you're in that mix, should they still be focused or viewed as toy companies by investors?
Well, what we do is so much more than toys. Toys is, the product is toy, but clearly it's about play, which is a broader concept. Our brands are so much more than toys. Our brands are cultural, the societal. Barbie is a pop culture icon. Nobody is thinking of Barbie today as purely a toy. Barbie is a pop culture icon. Hot Wheels is so much broader than small cars that drive, that you push and drive anymore. This is.
I still play with them, to be
and I know you're a big fan. I am. Of course, but as you know, Hot Wheels today is also much more than a play system. It's a concept that we own. It's a form factor. It's a world of wheels. It's a whole universe of opportunities and experiences that we continue to grow and expand. So while the journey started as, in the toy aisle, we do so much more than that. And it's all about the strength and the cultural resonance, the brand purpose that we infuse in our brands, and how we continue to expand the experiences, broaden the demographics that we appeal to, attract more adults and adult collectors into our business, and leverage brands that are societal, cultural, generational to have a meaningful impact across multiple categories that in some cases are much bigger than the toy industry.
We're coming up, believe it or not, the holiday season is fast approaching. Different holiday season this year versus last year, of course, with the election. Do you see toy sales up for the fourth quarter?
Well, we expect the industry to still decline, but less than what we thought at the start of the year overall. In the first 6 months of the year, the industry was comparable, which is better than what most people expected, including ourselves. So the industry is doing better than initially projected. And we expect the toy industry to continue to improve trends and return to growth over time. The fundamentals of the toy industry are very healthy. Toys play into a fundamental human behavior of play, which is not going away. Parents will always prioritize spending money on their children, especially when it comes to quality product and trusted brands. Toys are also very strategic for retailers. It's a category that invites foot traffic. It's experiential. Items are very affordable, and we're believers in the long-term prospect of the toy industry overall.
Lastly, there's been some chatter on the toy blogs. Yes, I read toy blogs because why not? About the potential Barbie sequel. Do you see it as an animated film? Is that the next place you can go with this?
Well, without commenting specifically on the Barbie movie or any one brand in particular, we've always said that we're looking to create film franchises. This is not just about one or two experiences. It's about how do you create a holistic experience and expression based on our brands for brands everywhere. And this is the approach we're taking across our entire portfolio. A very robust slate of great content, both in film and television, based on our iconic brands, and it's going to be worth the wait.
You still see a sequel for Barbie in some form?
Well, we believe that our brands can translate to multiple expressions. It's never necessarily just about one movie or one television show, and I'm talking more broadly, not just about Barbie specifically. But the opportunity for us is to create film franchises. And in the Mattel cinematic universe, the common theme is about brand purpose and cultural relevance. And we are looking to continue to infuse those elements into everything that we do, both in product as well as content. And we believe that much of the success that you saw with the Barbie movie is what we're looking to continue to evolve. And while we also said that not every movie will be necessarily a Barbie movie, it's the same approach, the same methodology, and the opportunity for us is to partner with leading filmmakers to create standout quality movies based on our iconic brands that will resonate in culture and appeal to global audiences. And that approach, that opportunity applies to Barbie, Hot Wheels, Masters of the Universe, Matchbox, and other brands that we look to continue to create and express on the big screen.
Always great to get some time with you. Mattel Chair and CEO Ynon Kreiz. We'll talk to you soon.
Thank you, Brian.
All right, Julie and Josh, back to you. And I just want to clarify, I don't really play with Hot Wheels. I just have them displayed throughout my house. But it is a real thing, and I will take the photo when I get back to New York and send it to you guys. Just want to clear that up before you all make fun of me.
playing with the cars. We get it. That's okay. It's all good.
The judgment-free zone.
Thanks.
You don't need to apologize.
Ynon says no need for me to apologize, but, you know.
Exactly.
I had to.
Exactly. All right. Thanks, Josh. Appreciate it. Well, stocks jumping today on the heels of the S&P 500's worst week since early 2023. For more on the latest market moves, we want to welcome in Ahmed Riesco. He is Insignio Chief Investment Officer. Ahmed, thank you so much for being here. So we had this bad week last week. Now we're sort of muddling along until we get the Fed decision. I think fair to say you are not a full bull at this point in time. So do you think that once we get past the Fed, that the market will be able to more sustainably rally?
Hi. So no, unfortunately, I do not. We actually switched our stance to U.S. equities to underweight at the beginning of July. We think we've seen the highs for the market for the year. And the reason why, it's basically because we continue to see concerns in the labor market, specifically the U.S. labor market. We see the job vacancy rate is flashing warning signs. I mean, there's a slew of indicators of labor demand that are pointing in the wrong direction. With that being said, a lot of the emphasis has been on the Fed and when and where they're going to cut rates. We think ultimately that only matters if the U.S. can avoid a recession. If it does not, we see a tough slog for stocks into the second half of the year.
So is that your forecast, though, Ahmed? I mean, do you see an economy beyond just cooling and moderating? Do you expect it to tip into contraction?
We do. I also want to emphasize, I don't think it's going to be a severe recession, unlike the two previous recessions, both COVID and the global financial crisis, which were severe exogenous shocks. We think this is going to be a much more run-of-the-mill type of recession where the Fed raises rates and tips us over into contraction. I mean, some parts of it might not even feel like a recession, but even in the case of a mild recession, we find it tough for the stock market to remain at these levels because even minor earnings revisions are going to put some weight down on the index.
And so, we're just sort of finishing up one earnings season, but it feels like they are sort of one runs into the next at this point. So do you think then that when the next earnings season starts in earnest, that'll really be sort of a rocky time as we start to see the effect of a slowdown really hit companies' numbers?
Yeah, we do. I mean, we think that the bar has been set quite high for the next earnings sessions. We're talking about double-digit growth in earnings expectations. We think that bar is going to be very tough for the stock market to meet. But even before then, we think we'll continue to see deterioration in the labor market data. There's an interesting sort of analogy here. You could say that with the Fed, the buy the rumor was the dovish pivot of 2023. The sell the news might actually be when they actually cut rates. We think there's a good chance that around the time that the Fed actually does start cutting rates, you could see the market materially drift lower.
So where in the equity market, Ahmed, do I want to be positioned then?
Yeah, as you can imagine, we're sort of tactically positioned rather defensively here. So we like defensive sectors. We like healthcare. We like utilities. We like consumer staples. We especially like the utility sector. I know that's been a very good performing sector. Like I said, we did these rotations back in July. The reason why I like utility so much is because I think you're getting the best of both worlds. Now, hear me out. I think you're getting the defensive side that's going to do well when the Fed is cutting rates. But you're also going to have a good proxy for growth and in the surge of electricity and data storage out there. For the first time in over 10 years, the U.S. electricity consumption is going to be growing by over 10%. So utilities, in a good way, are both a defensive play, but also a proxy to growth.
As you mentioned, that group has already done very well this year. It's actually the best performer in the S&P 500 at this point. So why don't you think it's sort of priced in the dynamics that you're talking about?
Yeah, well, precisely because we don't think U.S. equity markets are priced in recessionary risk. I mean, some parts of it are, right? Like utilities doing so well. But remember, the utilities outperformance really only began a few months ago. So we still think this has quite a bit to run. We'll probably maintain these overweights until the U.S. starts coming out of that recession. And then the more cyclical plays will start working again. We're talking about small caps, financials, those types of names.
Ahmed, always great to have you on the show. Thank you for joining us.
Great, thank you.
And still to come, shares JetBlue flying higher today on the back of an upgrade. We're going to check in on some of the top calls of the day when market domination returns.
We are here at the Goldman Sachs 2024 Communicopia and Technology Conference. I'm Madison Mills here with Brian Sozzi, our executive editor. We are thrilled to be joined by Kash Rangan. He is the managing director over at Goldman Sachs. Kash, you've got quite the coverage list, all the software names, the hyperscalers we love to talk about, but I want to start on this tech sell-off that we are in the middle of right now, the market recovering a little bit today, but what are you hearing from executives here at this conference, and how does that impact your bullishness on some of these AI names?
So I'd like to always say the three things that are important with software companies at this point in time: rates, elections, generative AI. So rates, we had Jan Hatzius, our chief economist, make his prediction that we're going to get a 25 basis point cut, maybe 50 basis point cut. But you cannot possibly underestimate the degree of confidence that tech executives would have because it means something to their end customers. The signal that the Fed sends that, look, the cost of capital for your business is projected to come down. So Jan's now saying that over the next several quarters or so, the rates are going to come down to 325, 350 basis points. That's a very different regime. So tech investments and tech spending overall, where there is a cost of financing element that is adding to that sensitivity, will start to feel alleviated. So you're seeing CFOs at this conference say distinctly when asked the question, what do lower rates mean for your business? Oh, the worst thing you could hear was, it's definitely not a negative, but the best thing, it is going to be a tailwind for existing customers to expand their deployments. So it all starts to add up and compound. Small little steps start to compound. Rate reductions give you a little bit of expansion in your current book of business. We call this NER, net expansion rates. It's been stable for the industry. It came down significantly over the last 3 years since things peaked in 2021, right? We're starting to see some stability. And if what the CFOs are saying, that rate cuts are going to be positive for expansion rates, that expansion rate starts to move up, which is, it has never moved up in the last 3 years. All it's done is just keep going down. That's a positive, right? The other thing that's also important is post-elections, less uncertainty. It's not important to nail what the new policies are going to be. It's more important to have less uncertainty and more certainty about what those policies are. My belief is that once we get through November, we're going to have, if it's not the outcome that you want as a business person, you're going to pull in your spending into Q4. If it is the outcome that you want, you're going to feel good and say, you know what, these capital projects that I've withheld will start to get approved. And then Gen AI, that more of a long tail thing. I'm very bullish how it unfolds eventually in the long term. But the proof points, if you're looking at proof points today, there's a scattering of proof points, but not enough to get conviction that this is going to be a thing in 25 or 26. So
when I talked to Jan this morning, he made a lot of good points, and he said he sees a series of rate cuts.
Yeah.
So if we get a series of rate cuts, a lot of these tech stocks that have been selling off now, are they back off to the races? More multiple expansion, earnings reaccelerate, and we're looking at some of these stocks, maybe they're up 20, 30, 40% from where they are now.
I wish. It would make my job so simple. In fact, I quipped when I was interviewing Jan on stage today that, oh, so your rates are going to come down, so it means multiples are going to go up and I'm going to have to upgrade my price targets. No, not that fast. With every tech cycle, there is with every economic cycle, as we come out of an economic cycle, coincidentally, there's always a new tech cycle that also goes with it. And if you're on the right side of tech, and if you got the goods, Salesforce into, Mark Benioff really was, 2009, 2010, distinctly remember, the economy is coming out of the correction, right? And cloud was in its infancy. And lifting out of the recession, and cloud was in its infancy, and cloud became the catalyzing force for the tech industry. You have to have cloud, otherwise you're going to be left behind, right? And so similarly, it's not as easy as saying lower rates are good. I mean, they're kind of the first lift. It's the primer. The next thing, it has to be followed by real innovation. If your net expansion rates go from 117 to 190 and they stall, it's no good. It needs to go up. We need to get the industry back from 11% growth rate to 20, 30%. Well, that new innovation needs to happen. You need to be the first to capitalize on Gen AI. Your products need to come out. You need to be able to improve your retention, upsell. When you compound that innovation with lower rates, magic happens.
Does that mean you think that Microsoft is the AI winner because they sort of do have first mover advantage?
I think this game is about capital, unfortunately, or fortunately for the hyperscalers. So you need to deploy, unlike prior cycles, the cloud was capital intensive, by the way. People forget that there was a lot of criticism of companies like Microsoft and Adobe. What are you doing? You're taking your 80% gross margin business and making it 70% gross margin? What the hell do you do, right? And if they had listened to investors and they had not spent the capital that they spent, we would not be talking about an $80 billion cloud business, whatever it is. So these are visionary managements that decided to spend, and this capital cycle is even more intensive of a capital cycle than the cloud was, right? Back then the cloud, today it's $1 trillion. give or take, a little bit less than that, where we're substituting on-prem with cloud, basically substituting compute with compute. That's all we did. Now we're augmenting human capital. Human capital, I don't know, 20, 30 trillion. That installed base of human capital is far more valuable. That's cognition capital than compute capital. So this cycle, if done well, is going to be huge. And if you're Satya Nadella, if you're one of these tech CEOs, hyperscaler CEOs, you're like, okay, I was lucky to get the cloud cycle right. Man, this cycle is not $1 trillion cycle. This is like multiples of trillions of dollars. I need to get on it. If I'm not the first mover, I'm crushed. As you know, you don't want to be even the third in the tech industry. It's either one or a strong number two.
All right, Cash, we got to leave it there. Thank you so much for joining us.
Thank you for having me, and I hope you have fun at the conference. This is a tremendous conference. Yeah,
yes,
thanks
we
for
got
coming.
a lot more news to cover on this conference and more. So stick with us right here on Yahoo Finance for more markets news ahead.
Thank you, guys. Time to check in on some of today's top analyst calls, sponsored by Tasty Trade. BofA Securities upgrading JetBlue from underperformed to neutral. Note highlighting that air travel demand is stabilizing. So BofA, more optimistic than they had been. They're on the sidelines here. Why the upgrade to neutral, Julie? Analysts talk about improving fundamentals, favorable industry backdrop, they say, and talks about how air travel demand has been stable in recent weeks as capacity continues to moderate.
Yeah, and the capacity part is important here because what happens with the airlines is anytime the travel demand picks up, they increase capacity like crazy, and then they lose some of their pricing power. And so now Bank of America says domestic capacity will improve this fall. It should rise 2% from September to November. There was a 6% increase in capacity earlier this year. So that's the moderating capacity that we're talking about here. The company also pointing out that JetBlue has recently flagged that its Latin America business has been getting better. And now Bank of America says that third quarter of this year's unit revenues should rise 4.2%, which is much better than their prior forecast.
Yeah, it does say high net leverage is still a risk for this name, told their clients, but neutral target goes to 6.
Gotcha.
All right, coming up, Palantir and BP announcing that they have signed an expansion of their partnership. We're going to speak to Palantir's head of energy and natural resources about the deal. On the other side, stick around, much more market domination still to come.
Wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs.
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
This morning, Palantir shares rising to a 52-week high and now up more than 100% so far this year. On Friday, it was announced that the software company will be joining the S&P 500. Analysts at Wedbush saying this is, in their words, a validation moment for the company. And meanwhile, today, more news. Palantir and BP announcing they have signed an expansion of their partnership, 5-year deal in which the oil giant will use Palantir's AI software to improve and accelerate decision-making across the company. Here with more is Palantir's head of energy and natural resources, Matt Babin. Matt, great to see you.
Thank you for having me.
So let's start with that news. So expanded partnership with BP. So the oil giant uses Palantir's AI software, improve, kind of speed up decision-making across the company. Matt, walk us through exactly what that means, though. Are there examples you can give us to kind of illustrate, okay, I'm a BP engineer, how this helps me?
Yeah. We've been working with them for more than a decade, and I think, as the release states, we've sort of worked on. You can think of their business as a complete connected value chain, right? From reservoirs underground up through their facilities, onshore or offshore, all the way to a refining or processing facility, all the way to an end customer. And so what they use our software for is all of the decisions along that chain. That's a complicated chain, and you can think of each decision you make along the way actually changes the decisions you can make downstream, right? So if you make one decision, that changes all of the other options that are available to you. What's new with this extension is layering AI on top of that underlying digital twin model of the entire business.
Gotcha. So it's extending in time, but also extending in scope of what you all are doing for BP.
Correct, yeah. So you can think of it does two main things. One is it connects people who have different area disciplines. So if you're a reservoir engineer, and you're paying attention to what that subsurface reservoir is like, that's much different than sort of an operations or base management engineer thinking of how could I change the performance of this facility. But this gives you one pane of glass to look at and collaborate over that. So that's one thing where it enables people, without sacrificing any specificity of the questions they're asking or the work they're doing, to work together. The second is, how can you then run hundreds, thousands, millions of simulations on top of those questions you're asking in a secure way?
And one question I want to ask a question on the street, Matt, for you particularly, in the energy segment, you're dealing with these energy companies. Is it often kind of one-time engagements, or no? What you're seeing is typically these are really now converting into long-term recurring revenue.
Yeah, I think the duration we've been working with them, a decade in, and we're signing up for 5 more years, says that these are long-term deals. We've founded the company to work on hard, mission-oriented problems. And those are places where our customers make decisions every single day. So, we've talked a lot about these boot camps, which are sort of 1 or 2 days, but then lead to long-term duration contracts.
Well, and we talk a lot about AI and sort of, obviously with the advent of large language models, there was a lot of talk about transformation, right? It sounds like what you're talking about is, and not to diminish what you're talking about, focused on efficiency, focusing on making operations better. Mm-hmm. Not that that's not going to be transformational in the longer term, but it's not like this sort of, overnight kind of change to the business.
Yeah, I think that's a good distinction. I think if you look at a lot of industries, energy being one of them, maybe 5 or 10 years ago, everyone was saying, I'm going to do a digital transformation project. Mm-hmm. And that's sort of like, well, why? Right? What's the real business problem you're trying to solve? And I think over the last 2 years, you've seen a lot of that in the AI space, right? I'm going to AI this problem. And we take we're contrarian in a lot of ways, but we take the view of, well, what's the core problem of your business, right? If the core problem of your business is, how can I produce more energy with safe operations and reduce emissions, that's the problem, right? And then the question is, how can I use technology, including AI, to improve the way I tackle that problem? And so, yes, on the edge, I think those look like marginal improvements, but if you get 1% better at what you're doing every single day, that's how we think you transform your core business.
And when you signed this expanded partnership with BP, Matt, I'm just curious, was there competition there? Was that a bake-off?
I think there's competition in software all the time,
Yeah.
right? I think your previous guests were speaking about sort of what everyone is trying to do in the space. The most frequent competition that we see are, I think in energy in particular, there was largely a choice between two ways of working. You could go to a hyperscaler and sort of have a horizontal infrastructure system when everyone went to the cloud and then cobble together individual components of that yourself. Or you could buy bespoke software that did one particular thing. And what we do is say you shouldn't have to make that choice. You should be able to scale while also being able to solve specific problems. You have PhD level experts in all of these component pieces of that workflow. They shouldn't have to trade off the power of their knowledge because of the tool set that they're using.
At some point, are there diminishing returns from, in other words, if you are improving efficiency analysis of a reservoir, for example, at some point you've done it, right? So then what?
Yeah, I don't think there are yet. And I think you can look at that in terms of, great, so let's take that example on the reservoir, right? The rocks are the rocks, right? And there's only so much you can do with those rocks. But if you can free up more time for people who are managing that asset to go do more exploratory activity, right? If you look at the sort of generative space of going into, well, what does carbon capture look like? What does using these reservoirs and these storage caverns underground look like for sort of new parts of the energy transition problem? I view it more as, I'm an economist by training, so it's what's the opportunity cost of spending time? So even if there's diminishing returns to one particular problem, you're freeing up more time to tackle new problems and add them into the mix, and that's what we see our customers.
Matt, there are companies out there who would certainly like to compete for your customers, right? These companies, Microsoft, the Databricks, they're really putting real effort into this. How do you see just the competitive landscape kind of evolving from here?
Yeah, I'm more focused on what we do than what other people do, because building great software takes your entire focus, I think.
And what do you think are your competitive advantages there?
I really think it's the depth and time we've put into the ontology, right? If you look at, again, let's use the example of BP, that pressure system, that's not just the nouns and the assets that they use, that's all the verbs between them, right? The actions that you take, the decisions that you make as a company. And so building that flexible framework for a data model for the way your company does business, if you do that part right, then you can layer anything on top.
I want to come back to what we were talking about in the beginning, that you guys are being added to the S&P 500, which I know is not in your purview, doesn't affect your day-to-day, but we were talking in the break just sort of about that milestone for the company. Is that something you guys are sort of talking about internally, excited about, or are you just really focused on what you're doing?
Of course it's exciting, right? It's a big piece of news. There's three different ways that I think about it. I think the first one is just keeping it in the energy domain, right? The energy space is full of standards, right? There's safety standards, there's construction standards, and the rigor around meeting those standards is pretty high. I think the rigor that the index keeps on getting in is equally high. And we used to get asked all the time by energy companies when we were smaller and younger, okay, great, the tech looks fantastic, but I make decisions on decade timeframes. I'm going to be operating this field for a generation. Are you still going to be around? And I think that's sort of a signal to the market as a whole, but particularly in energy, yes, we've met these standards and we're here to stay. I think the other is, someone who came out of the government space, who worked on the government side of our business, you don't have to choose between being a mission-oriented company and being a commercially successful company, right? We haven't sacrificed anything on our mission and our intent on the work we do on that side. As a personal employee, the work I have to do today and tomorrow is the same as it was if the announcement had been different on Friday. So nothing there changes at all.
Matt, thank you so much for joining the show today. That was great. We appreciate it.
Thanks for having me.
While we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street, and now it's market domination overtime, sponsored by Tasty Trade. Let's see where the major averages ended the session as we saw this bounce back from the sell-off that we saw last week here. Those sharp declines that were the worst start to a September, going all the way back to 1953, according to Bespoke. If you look at the 5-day chart, you get a feel for that drop that we had, at least for the Dow here. But the Dow coming back today by about 1.2%, 484 points. The S&P 500 up 1.2%, and the Nasdaq up about 1.2% as well. Nothing particularly changed today necessarily, just seeing that sort of reflexive bounce back. Now the market has set its sights on CPI coming Wednesday, although that number has gotten a lot less important as the attention has shifted more to the labor market and whether it is strong enough to continue growing here. And then, of course, to the Fed decision, which comes a week from Wednesday. So if we look at some of the individual stocks that we're watching today, got to talk about Apple, of course. Wanted to check on where it has ended the session. Not much of anywhere is the short answer to that, but we should say it's up from the decline, from the lows where we saw it earlier in the day. That's after we learned there was not going to be any new Apple Intelligence features that were introduced today. So coming back up to the unchanged line, I guess by that measure, is not so bad. A couple other stocks to highlight here. We were just talking to Matt Babin of Palantir. We learned that that company is going to be going into the S&P 500 as of the open on September 23rd, catching a bid up 14%. And we are awaiting Oracle numbers in just a bit. That stock down 1.3% on the session going into those numbers. Josh?
All right, Julie. Stocks looking to recover some of last week's sharp declines to start September. Our next guest says the consumer is the key to the market puzzle. Joining us now is Alex McGrath, North End and Private Wealth CIO. Alex, it's good to see you. So you say, Alex, I like this, that the market, you say, seems to be mirroring our national mood here. What do you mean by that, Alex?
We're coming off the back end of a pretty long inflation battle here with rates being at historic peaks. And, you look at the underlying macro data that we're staring at every day, and it's not exceptional, but it's not bad either. It's just kind of in this middling phase. And, certainly a much better start to this week than we had last week. But, how much of that was really like recession fears, or how much of that was really, we certainly favor that had a lot more to do with that jobs number coming the prior Friday, and then you had all these whispers coming out. Potentially a 50 basis point cut got whispered into a quarter basis point cut, and then you had some turmoil there throughout the week, and now we seem to be back on track. So we'll see where it goes. But we're just kind of in this middling spot where, growth isn't fantastic, but it's not bad, and, jobs numbers aren't horrific, but they're not great. We're just kind of in this middling situation here.
What's going to change that, Alex? What's the next? Is it going to be the Fed? Is it something else you're looking to?
I would love to say that it's going to be the Fed riding to the rescue, but we all know that any kind of cuts or any kind of actions the Fed's going to take is going to take time to work through. And I don't think you have to look much further than a lot of the numbers we've seen from the consumer discretionary companies, where they're slashing forecasts because the demand just isn't there like it has been. And that's not entirely surprising. I know we keep hearing, inflation's way down. And that, certainly from a year over year perspective, that is absolutely true. But the problem is there's 20 to 30% built up in there. That's still increasing on a month over month basis. And it's just, the consumers got to get tapped out at some point. And, I'm not saying that's like a death and destruction phase coming, but you are starting to see inklings of that. And, the Fed lowering rates will help that down the road, but I don't know that there's any super immediate fix that they can do from the Eccles building in DC.
So Alex, if that's your view of the Fed, the economy, the consumer, how does that sort of shape your view of the markets, Alex? How do you want to be positioned in the equity market?
Well, certainly we feel like the next couple of months here could be a bit rocky. That's, not death and destruction, but it's just more taking a, tactically defensive approach, going out and grabbing utilities, industrials, healthcare, real estate, consumer staples. Typically defensive positions like that are interest rate sensitive should be a good spot to sit in right now, just because with interest rates potentially going backwards, and those defensive positions should buoy a lot of those or that section of the equity market. And so that's kind of where we've started to shift some things. That doesn't mean we're wholesale abandoning the large tech growth trade, But it's just like repositioning some of the edges to get a little bit more exposure into those more defensive positions.
Gotcha. Where in tech still makes sense to you here?
Certainly, or I would say to us, semiconductors are really the new industrial, in our opinion. Those are just pieces that go into everything. Where you're looking, so that would be the number one spot. Certainly the large cap social media companies. I don't really have a ton of thoughts there, but for us on the tech side, it's all about semiconductors.
What about for fixed income investors who are listening right now, Alex? What's your guidance?
Ooh, that's been an interesting conundrum for the last 2 years there. Certainly, when all of this started, floating rate looked great. The shorter end of the curve was fantastic because you were participating in all of those interest rate hikes along the way, getting upwards of 6% on basically market neutral money. As we start to look at rates coming backwards, it's probably time to start taking some duration there. We've started to do that a little bit, not going way out on the curve, maybe in that 1 to 5 range. And, so that's kind of where we're sitting on the fixed income side. But, floating rate's been great this whole time. But everybody that's sitting in those floating rate and money markets, it's probably time to start moving that duration play out a little bit. And again, I'm not saying play the 10 to 15 or 20 to 30 curve, but certainly starting to bump that out a little bit should pay some dividends for people.
And finally, Alex, I know you're watching the consumer real closely here. What are you going to be sort of focusing on metric-wise in order to figure out the health of the consumer going forward?
Certainly keeping an eye on retail sales. I know the last measure we got was fantastic on that front. So we'll kind of see what the next look looks like, and as well as the revision. But it's really for us watching the consumer discretionary spending space and those consumer discretionary earnings report to try to get a good idea of what that looks like. And that will certainly, those are the number one things that we're looking at as it concerns the consumer going forward. Like, what does that spend look like? And how does that translate into the next couple of quarters? Because that ultimately will alter our asset allocations.
Alex, thanks a lot. Appreciate it.
No, thank you for having me, guys.
Let's get to some earnings from Oracle here. Those numbers just hitting the wire here. And we're looking at adjusted earnings per share about 6 cents above what analysts had been anticipating at $1.39. The company's first quarter adjusted revenue, $13.31 billion, $13.26 billion is what analysts had been projecting. Fiscal first quarter, obviously, here for Oracle. And in particular, its important cloud infrastructure division, revenue there at $2.2 billion. That just about matched what analysts had been anticipating. I'm going to continue to go through the release, but at the same time, the company is also announcing a new partnership, it looks like, with Amazon Web Services to introduce something called Oracle Database at AWS. Again, I'm going to keep looking into this to see how significant it is, but they put out a press release to that effect as well.
Yeah, Oracle CEO Safra Catz giving some color there, saying big news, she says, signing a multi-cloud agreement with AWS. AWS customers will get easy and convenient access to the Oracle database when we go live in December later this year. Oracle Chairman and CTO Larry Ellison also talking about that, says the signed AWS contract, a milestone, he says, in the multi-cloud era, so we'll certainly want more context and color on the call about that. Ellison, by the way, going on to say that Oracle now has 162 cloud data centers in operation and under construction around the world. This stock, heading into this print already, Julie, it had a really nice run. It was up about 35% year to date and tacking on more gains here in the after hours.
Yeah, it's interesting to see that. It's interesting that they just matched that first quarter cloud infrastructure revenue, and the stock is going up to such extent, maybe in part because of this AWS partnership here. That increase, by the way, in that unit, I believe, is 46% year over year. And basically what that business is renting storage and computing in the cloud. That's that cloud infrastructure business that we mentioned here. So something else to mention, by the way, is that we've been bringing everybody coverage of that Goldman Sachs Communacopia conference. Matt Garman is the CEO of AWS, and he's going to be joining us, at 5 p.m.
Good timing.
Yeah, most definitely.
All right, coming up, we're heading back out to the Goldman Sachs Communacopia and Technology Conference as Brian Sozzi will sit down with AMD CEO Lisa Su. Stick around, you won't want to miss that one.
Welcome back to Yahoo Finance's coverage of the Goldman Sachs Communacopia Conference in San Francisco. Really special guest right now in Yahoo Finance. That is AMD Chair and CEO, Dr. Lisa Su. Lisa, good to see you. I was telling my team, I've been talking to you for 10 years. I've never seen you in person. So good to see you.
It's great to see you as well, Brian. Thanks for having me.
Yeah, of course. Are you kidding me? So I listened to your webcast. You were just off your fireside chat. And I think how you ended it is how I want to start this conversation. You reminded a lot of investors this is a super cycle for AI. Take us through that a little bit, and how do you see AMD playing in that?
Yeah, so absolutely. I mean, we've really talked about what we think is the potential of AI in this accelerator area. I believe this is a market that will grow to $400 billion by 2027, which is huge, and it is an AI super cycle. Sometimes people get caught on what's happening today, what's happening tomorrow, the next quarter. What I'd like to say is you have to take a step back and look. As a tech company, it's our job to make bets that are really for 3 to 5 years out. And 5 years ago, we thought AI was going to be super important. It's much more important today. It's a much larger cycle today than I would have expected 5 years ago. We're making big bets now for the next 5 years. And the key is there's no one size fits all in this technology race. It's all about end-to-end AI. So whether you're talking about the largest cloud environments, or you're talking about what you do with the embedded and edge space, or you're even talking about AI PCs, you're going to need the right AI computing for the right workload, and that's our job at AMD.
I like that you sent a message also too at the end of your presentation. There's not just one company playing in this super cycle. Talk to us about that.
That's absolutely true, because again, if you start with depending on your workload or which customer, you're going to need different types of compute. And what we've learned dealing with our largest customers is this is about deep partnership of how you optimize hardware and software together. So look, we're super excited about the progress we've made in AI. Our MI300X was just launched less than a year ago. It's the fastest growing product that we've ever seen at AMD. So this year, last year it was maybe less than $100 million of revenue in AI. This year it'll be greater than $4.5 billion. So that's pretty nice. But this is really just the beginning of that cycle, and we're super excited about what we see going forward.
Of course, that chip, that new chip, very powerful and very important. What does the backlog look like for next year?
Well, the key for us is we've actually accelerated our AI roadmap. So when we look at how fast AI is moving and how fast the models are moving, we need to have the latest and greatest technology every year. So we actually are now on a 1-year cadence of new products. So later this year, we're going to announce a new product, our MI325. Next year, we'll have an MI350 series. In 2026, an MI400 series. So you're going to get to know AMD products really well. And the key is we believe that we can have a very significant piece of both training and inference of these large language models.
What are some of those newer chips that you just talked about? How will they be different than what you have in the market now?
The key is more performance at lower cost. I mean, that's the bottom line. So for the largest data center operators, you want to be able to train your models as fast as possible. You want to be able to ask your model questions at low cost. This is all about total cost of ownership. And the way we get there is we put more computing on a single chip. And if remember, Brian, one of the things that we've really pioneered is this idea that you could, actually break up these large, powerful AI capabilities with something called chiplets, or really breaking it up into different technologies. This is a huge advantage for us. It's one of the reasons that we are, really leading in some of the key workloads today, and we look forward to where we'll be able to take this in the next generations.
What has surprised you about the build out of AI infrastructure in this country?
What has actually really surprised me is just how fast the technology is moving. I mean, what we are seeing is whether you're a large hyperscaler or you're an enterprise customer or you're the newest AI startup, it's all about speed. We're all learning at an incredibly fast pace. Even ourselves at AMD, I would say that we've learned more and done more in the last 9 to 12 months than in the previous number of years, because the market is moving so fast. And this is a place where innovation begets more innovation. And so we're learning a ton on the software side. We're learning a ton about what is the most efficient way to get these products to market. We've done a number of acquisitions, which I'm very excited about.
Can't keep up with all these deals, Lisa.
Well, look, we're a growth company, and as a growth company, our job is to invest and invest ahead of the curve. We've done now 3 or 4 acquisitions, 3 in the last, let's call it, year, and then we just announced a new one.
Xilinx and then ZT.
Yeah, we've done, Xilinx was actually back in 2022, if you can believe that. We did Xilinx, we did Pensando on the networking side. They were very AI hardware and software centric. We've done several software acquisitions, mainly so that we could make it easier for our customers to adopt AMD architectures. And then most recently, last month, we announced our intent to acquire ZT Systems, which builds out, sort of the system infrastructure. And the key is all of these pieces are important, but we've been investing for a number of years, both organically and inorganically, so that we can be that computing partner of choice to those who need high-performance compute.
This is, of course, a very exciting time for all things AI, but the supply chain is not diversified. And you talked a little bit about this in your fireside chat here. I mean, how do you, and TSMC, great partner, it sounds like, for AMD, but how do you diversify from having all of your production in Taiwan?
Well, look, we're always thinking about supply chain resiliency. I think we all have to, just given the world's reliance on computing and high-performance compute. TSMC is a great partner for us. We do want more diversity in the supply chain. We are actively both putting our tape outs or our new product designs into TSMC in Arizona, as well as looking forward to ramping those. And we're going to continue to work with the overall ecosystem. I'm a big fan of the CHIPS Act and the work being done so that we could increase the domestic manufacturing, and we're going to continue to work on it as we go forward.
Is it an economic risk for the U.S. to still have so much production overseas like this?
I think we're in a place where we must have geographic diversity, and I think the work that has been done over the last few years, both CHIPS Act on manufacturing, as well as Brian, I'm a big fan of the R&D efforts, because the work that's being done in the National Semiconductor Technology Center to build a semiconductor R&D footprint is extremely strategic. So those things have to be done. There's no one thing that's going to make this all of a sudden better. I think we need to keep working on investing, and this is about public-private investment to really strengthen the semiconductor resiliency.
Before I let you go, what has it been like to just lead this transformation at AMD? And I mean, how much longer do you want to be doing this? I mean, you've been at AMD for so long, but you've led this amazing transformation, and I'm just curious on what else do you have left to do?
Well, look, I am extremely fortunate. Frankly, all of us in the technology industry are extremely fortunate that we are working on technology that matters. Like, that's what gets me up every day is, the products and the technology that we're working on really does change the world, really does impact, sort of how we're going to experience services, really does impact how businesses operate. And for that, there's no better place to be. I mean, this is incredibly fun. And I actually think, as fun as the last 10 years have been, when you look at how technology has evolved, the next 10 are going to be much, much more exciting, because you can really see we're unlocking, sort of with the power of AI and computing, we're unlocking things that we never believed were possible before.
Really working on some amazing things over there at AMD. AMD Chair and CEO Lisa Su. Let's hopefully not wait another 10 years to hang out in person again. Appreciate it.
Thank you, Brian.
All right, guys, back to you in New York.
Thanks a lot, Brian. Appreciate it. We'll switch into politics here. On Tuesday night, Vice President Kamala Harris and former President Donald Trump will meet for the first time in a debate with economic issues likely to be front and center. For more on what to expect from this high-stakes event, we want to bring in Yahoo Finance Washington correspondent Ben Worschel. Ben, not only the first time they're meeting for a debate, the first time they're meeting at all in person, and maybe the only debate. We don't know yet. There's not another one on the calendar. So from an economic perspective, what do we really need to hear from the candidates? What do we need to learn?
Sure. So the policy kind of question that's coming in, and it applies to the economy for sure, is defining Kamala Harris. There was the political world right now is talking about a New York Times Siena poll, and one of the big takeaways was that 28% of voters said they still need to learn more about Kamala Harris. So the question is, what do they learn at this debate? And when it comes to the economy, Kamala is she's been spending the last week trying to sort of set things up this way. She's a friend of small businesses. She had a small business plan last week. She released her issues page, which was really focused on the economy. Trump, on the other hand, is trying to tie her to the unpopular Biden administration as much as they can. Obviously, she's the vice president, so she can't distance herself that much. There was a call with Trump folks this afternoon, and they called her the co-president. So that kind of gives you a sense of what the Harris or the Trump people want what Trump to say. Whether he says it is up in the air, And then there's a lot of other issues that'll be there, especially sort of in terms of the personal tax that'll likely be going back and forth between the two of them.
Ben, is your gut that this is maybe the first and last debate?
I think that's unlikely. There's still possibilities more. The Harris folks have said that they'll talk about it after this debate. So I guess it depends on how it goes. So it's not out of the question. There will be a vice presidential debate, so we'll have one more debate. But this may be the one and only time that these two people, literally in their entire lives, have actually been interacting with each other. They've been in the same room in the past, but this will be the first time they've ever directly interacted.
Ben, I'm curious what the perception is of Trump's weakness on the economic front. Is it tariffs, for example? That's certainly something that a lot of economists have talked about.
Yeah, I think tariffs are the big one. I mean, one of the tariffs has been setting up in the last few weeks is a real sort of push on these tariffs. She calls it a national sales tax. There's a stat out there that if you go the full Trump effect, 60% tariffs on China, 20% tariffs on all of our trading partners, that's $3,900 per year for a typical family. So she calls it a national sales tax of nearly $4,000. She will, undoubtedly, she'll mention that when she can. The question is whether Trump engages on it. His signals are that he's not backing down from his tariffs at all, but the question is whether he actually has to defend them in some substantive way and respond to things like that, because it indisputably brings up prices, and even some Trump supporters will say that.
Ben, great to see you and have you on the show. Thank you, sir.
Thanks, guys.
Time now for To Watch Tuesday, September 10th, sponsored by Tasty Trade. Starting off on politics, Vice President Kamala Harris and former President Donald Trump are debating in Philadelphia tomorrow night. This will be the first time the two go head-to-head since Harris accepted the Democratic nomination. The debate is going to air at 9 p.m. Eastern on ABC News.
On the earnings front, we'll get some numbers throughout the day tomorrow, including Petco, Dave & Buster's, and everybody's favorite meme stock, GameStop, of course.
Moving over to the economy, the monthly NFIB Small Business Optimism Index is coming out in the morning. Economists forecasting that number to hold steady at 93.7, giving us more insight into the health of small businesses in the U.S.
And finally, continue to tune into Yahoo Finance tomorrow for more coverage of the 2024 Goldman Sachs Communacopia and Technology Conference in San Francisco. We're going to have interviews with CEOs from Lyft and Hasbro tomorrow in the 3 o'clock hour.
That'll do it for today's Market Domination Overtime, but don't go anywhere. On the other side of the break, it's asking for a trend. I'll check in on the top moves from the day, including recapping the Apple event. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. A busy afternoon for the cloud software space. Oracle shares jumping after the company reported better than expected first quarter results. Software giant also announcing partnerships with two names in the Magnificent Seven, Amazon and Google. And it was Apple's big day, the company unveiling the iPhone 16 and 16 Pro, plus new watches and AirPods. The Apple shares not getting much of a boost over vague timing around the launch of Apple Intelligence. The tech giant saying English versions going to roll out next month, but other languages won't be launched until next year. Plus, the Wall Street sell-off last week now in the rearview mirror. Stocks rallying more than 1% across the day as the market looks to recover from the worst week of the year. Oracle shares jumping as it delivers a beat on earnings for the first quarter. The software company also announcing a partnership with Amazon Web Services as well as a multi-cloud partnership with Google Cloud. Here to discuss it all is More Insights and Strategy founder, CEO, and chief analyst Patrick Moorhead. Patrick, always great to see you. I want to start, Patrick, with the news. Let's get your take on the earnings print, and also, of course, Patrick, what Oracle CEO Safra Catz is calling here, her words, the biggest news, a multi-cloud agreement with AWS. What do you make of it?
Yeah, so this company's on a roll. I mean, like you said, had a beat, but the big news is this deal with AWS. And Josh, hell hath frozen over, okay? These two companies have been essentially at war with each other since AWS was formed 15 years ago. And AWS's thesis before this was they were going to take out Oracle, and that was in addition to Azure and Google for these large enterprise customers, and they would use their database. But what's clear today, and this adds on to the deal that came previously with Microsoft and then Google, was that Oracle database is very much alive and well, and their enterprise customers are demanding it. So literally, they're putting Exadata database boxes inside of AWS and giving customers the ability to run the autonomous database on this as well. And what this means for, let's say, AWS is AWS customers who use Oracle as their database can more easily use that data with AWS services, let's say like Bedrock or generative AI.
And so, Patrick, I'm looking at the reaction right now. Oracle's shares are surging on this. We're up 8%. And by the way, year to date, this stock had already rallied very hard. It's about 35% heading into the print. You've seen an 8% move, Patrick. Does that seem justified to you off this news?
It absolutely does. And for the savvy investor, what they recognize is there was this standoff that was happening for 10 or 15 years between Oracle and these classic cloud providers. And what they see is that enterprises want Oracle. They're not going to dump their Oracle database and just shift over to a cloud database. Some have, but not a lot. And they're seeing what this means for the long term for Oracle.
And so I'm curious, Patrick, often, listen, you're on the show a lot. We talk about the cloud wars. You talk about the giants and Amazon and Microsoft and Google. How does, and taking this news into account today, how do you think about Oracle's and Larry Ellison's place in that fight, how they compare and contrast?
Yeah, so first and foremost, Oracle is the only company that just does commercial customers. Amazon, Microsoft, and Google, they do commercial and they have consumer plays. And where Oracle has been exceptionally strong has been in the largest enterprise governments that require the most security, mission-critical environments, and very highly regulated. So in the cloud space, they very much compete with both those companies. And there's really three facets of cloud for Oracle. And the first one is this classic infrastructure as a service called OCI. While not nearly as big as, let's say, AWS or Azure, it's really targeted at those customers that I talked about. And in fact, Azure actually outsources some of its infrastructure to Oracle, particularly on the GPU side. And then you have the SaaS business, the software as a service, competes primarily with Microsoft. That is a cloud play. Now, while cloud is a smaller percentage of revenue than some of these other companies, their commercial business is bigger than Google Cloud. Their commercial business is 60% the size of AWS. So on a scale basis, they're doing quite well.
And Patrick, now we wait for the conference call. I'm curious, Safra Katz will be on that call. I would imagine Larry Ellison too, of course. I'm sure Mr. Ellison will enjoy taking a victory lap on this stock move in the after hours. What is their play? I'll get you out of this, Patrick. What is their play in AI specifically?
Yeah, their biggest play in AI is data. Josh, the number one thing, our channel checks clearly show that the biggest obstruction from enterprises going hardcore into AI is the data problem. It's getting the data right. It's commingling the right data to give generative AI the right solutions without leaking confidential information. And for the customers I talked about, Oracle is the place to go. So they will be the data broker for the generative AI age for those large customers. That's their play. And also they have this infrastructure play with OCI where they're essentially leasing out GPUs for some very large customers out there, including Microsoft, and I believe part of OpenAI.
All right, you can see there, Oracle shares popping 8%. Patrick, great to have you on the show today, my friend. Thank you for joining us.
Thank you.
U.S. stocks on the mend from last week's sharp declines to start September. Yahoo Finance's Josh Schaefer joins us now with the trading day takeaways.
Hey, Josh. Yeah, so it's the first trading day since the S&P 500 and Nasdaq had their worst week of 2024. So we're taking a look to start at just what led us off the bottom here, what led the bounce today. Initially, it looked like it was a little bit of a broader rally, and it narrowed slightly, and we ended up having tech lead. But overall, when we take a look at the sectors here, you saw pretty broad participation today. You got green across your screen. You've got 5 sectors outperforming the S&P 500. Again, I mentioned that late rally in tech seemed to really be led by Nvidia, which ended up closing up 3%. But the takeaway for me in this market over the last really 2 months now, going back to the start of July, has just been the broad participation. It hasn't all been about tech. The S&P 500 was in the green today, up over 1%. Before you got tech sort of joining that rally, then it just brings it even higher. But the S&P equal weight also closing up above 1%. And I'll take a look here at 2 months just to show you sort of what I'm talking about. Look at tech all the way over here, right? And you've got comp services all the way over here. So you've seen a lot more broader participation. And I think it's probably a good thing for some investors to see what we see when we look at the intraday coming off the bottom, to see all those other sectors participating in and not just being, okay, tech sold off last week, everyone's going to go buy tech stocks. People are seeing opportunity elsewhere still.
Yeah, I heard some technicians, though, calling this, they said it's a sentiment tightrope right now, though, Schaefer. That's what they said. I think, of course, you got, it's just these crosscuts.
Tightrope's scary, man.
Well, yeah, meant to be scary. Their point, you got a Fed rate cut cheer, you got, though, recession fears, you got politics. A lot going on.
Hopefully we don't slip on that tightrope.
Yeah, we'll see.
One other thing we're watching here, Josh, the market rally, again, I was saying isn't all about AI. And these are 2 charts from Lori Calvasina over at RBC that sort of caught my eye. So this is the top 10 names relative to the S&P 500, their performance. These charts had just been going up, and that was something we had been watching. Over the last month, you can see here, we've really taken a step down, meaning that the top 10 stocks are no longer significantly outperforming the S&P 500. A reason we look at a chart like this, look at what the dot-com bubble looked like, right? So we had a concern of, okay, if this just keeps taking off and it's only a couple stocks, that's not a really good sign of a strong bull market. Another chart that Calvasina highlighted that stuck out to me, similar in nature, concentration of S&P 500 companies as a total percent of market cap. So your top 10 stocks were at an all-time high. We're coming significantly off that. Same with the top 5. Essentially, this again showing us that it is not just Nvidia, it is not just 3 stocks. And I think, Josh, the takeaway for me there being, okay, so what drives this market? And that seems to be shifting a little bit. We're not just talking about AI earnings and AI spending. There's some other things, I think, moving forward.
Cattle said, CPI, Fed.
CPI, Fed, weakening in the labor market, right? When you look at the S&P 500, I'll pull it up here for us. Over the last month or two, when you see downsides within the S&P, you can basically always track it to some kind of weakening in the labor market, right? So we have it up here. Let's take a look at a 2-month. And when you see large downdraws, these are your jobs reports, right? You had 2 weak jobs reports. That's when the S&P 500 has seen pressure recently. It feels like we're in a bit more of a macro market right now, something to focus on headed into the Fed next week.
All right, Joshua, thank you. Appreciate it. Stick around, more Ask for a Trend right on the other side.
We are here at the Goldman Sachs 2024 Communicopia and Technology Conference. I am here on set with our executive editor, Brian Sozzi, and we are thrilled to be joined by Toshiya Hari. Toshiya is, of course, the lead analyst covering semiconductors at Goldman. Thank you so much for making time with us. We got to start on the Nvidia of it all. You've got to buy on Nvidia despite the record sell-off we've seen in the stock over the last week. Make the case. Why are we still a buy?
Yeah, thank you for having me. First of all, it's great to be here. So we've had a buy rating on Nvidia for quite a long time, and to your point, the recent performance hasn't been great, but we do remain positive on the stock. A couple of things. I would say, first of all, demand for accelerated computing continues to be really strong. We tend to spend quite a bit of time on the hyperscalers, the Amazons, the Googles, the Microsofts of the world, but you are seeing a broadening in the demand profile into enterprise, even into sovereign states. Number two, I think their competitive position continues to be really strong. I think at this conference you'll hear from Nvidia, Jensen Huang, we have Lisa Su, we have a couple of the hyperscalers at the show as well. So there is a bit of a merchant versus custom silicon debate going on, but we do think within merchant silicon, Nvidia is the go-to. And even versus custom silicon, they've got the edge in terms of the pace of innovation. And last but not least, from a valuation perspective, perhaps for the wrong reasons, but the stock has come in quite a bit. On our numbers on next year's earnings, the stock is trading in the low 20s, which I think is very inexpensive for a stock with this kind of profile.
Do you think the sell-off is just overdone?
Yes, we do. I think clearly the stock had great momentum until sort of the June, July timeframe, and stocks never go up in a straight line. So we kind of appreciate why the stock has given back some. I think the debate around is this sustainable into 2026 is a fair debate.
So people are looking beyond 2025. They're
Yes.
valuing Nvidia on 2026 already?
Valuing on 25, but depending on how the outlook is into 26, what kind of multiple you apply to 25 numbers is kind of the key debate. And interestingly, we were having a very similar debate 12 months ago in 2023 when the stock was sort of range bound the back half of 23, and that was due to, again, multiples going from, call it 50 times down to 30, 25. And back then it was, okay, 24 is kind of in the bag, but what about 25? So we're having a very similar conversation as of today into 26.
When you look back on this earnings cycle so far too, there was this big question about ROI on AI, investors getting a little bit of fatigue perhaps on the amount of money being spent on AI. How much of a headwind could that be for Nvidia if companies are getting dinged for their spend on the expensive Nvidia chips?
Yes, I think it is something to look out for. Again, lack of customer ROI, whether it be the hyperscalers, whether it be the enterprises that are trying to leverage AI, that becomes a problem at some point, right? We need monetization for this to be sustainable. I think the hyperscalers do make a pretty good case in terms of their ROI. I think if you look at ad revenue, you look at things like Instagram, the platforms, they are leveraging AI and they are getting the return. So we're confident as a collective unit that this is sustainable, but to the extent there's a lack of monetization, that could be an issue for not just Nvidia, but for the overall ecosystem.
You mentioned the hyperscalers, that's the Amazons, Metas, Microsofts of the world. They're building their own chips now, and they're certainly cheaper than Nvidia's. Can they ever compete directly with Nvidia and take up more market share than they are currently?
So they do. They have been competing with NVIDIA in some shape or form. I would say most of the custom silicon is there to address internal workloads. In the case of Google, it would be Google Search. But GCP, which is external looking, they're still buying a boatload of NVIDIA GPUs. And you can make the same case for Amazon. So I think you'll see a bifurcated market where, again, the internal workloads are addressed by their custom internally designed silicon. But what's outward looking, they'll continue to buy NVIDIA GPUs, AMD GPUs, and so on and so forth.
Important to note, you're not just the NVIDIA analyst for Goldman Sachs. On the other end of the spectrum, you cover Intel. And on the other end of the spectrum, you have a sell rating on Intel. Now, this stock is near historic lows. They're announcing thousands of layoffs. Earnings are depressed. What does Intel need to do? I won't say save itself because that's just ridiculous, but how do they get their stock working? And when do their earnings start to improve? And when does the investment thesis start to improve?
It's a great question. To your point, to your question, we've been pretty cautious on the stock for some time. I think for starters, it would help for the company to start hitting what they guide to, right? They've disappointed the market quite frequently, and that's never good for a stock price. So that's number one. Number two, medium to long term, they definitely need to get on par, if not exceed or surpass TSMC from a process node technology standpoint, because without that, they are behind the curve from a foundry standpoint. If they don't have the best tech or good tech, customers are not coming to Intel. They're going to continue to work with TSMC. And then on the product side, you can't really compete effectively with the likes of AMD, Nvidia, Qualcomm, so on and so forth.
Do you think they will ever be Intel again, where they are in that same discussion within Nvidia, AMD, or their time has passed?
Never say never, but I think it's fair to say that it's going to be an uphill battle because, again, in hindsight, they were perhaps complacent, didn't make the right investments. They sort of allowed TSMC to catch up and to beat them. If you're a customer of TSMC and you've got this massive opportunity set in front of you that is AI, for you to essentially leave TSMC and go to Intel or any other foundry for that matter, that's a lot of risk. So I think for Intel for sure, but even companies or foundries outside of Intel to compete with TSMC in the broad growing ecosystem, again, it's going to be an uphill battle.
Toshiari, thank you so much for joining us and making time. We really appreciate it. And thank you to our audience for listening. Stick with us for more of your markets coverage right here on Yahoo Finance.
Apple debuts its newest iPhone at its product event in Cupertino, California. The tech giant, however, provided minimal new information on Apple Intelligence. Let's get to Yahoo Finance's very own Dan Howley with the top takeaways of Apple's Glow Time event. Dan.
Yeah, Josh, as you pointed out, there were the new iPhones. We have the iPhone 16, iPhone 16 Plus, iPhone 16 Pro, and Pro Max. They had new Apple Watches, new AirPods, but really the big star of the show was supposed to be Apple Intelligence, but they didn't give us much as far as new features or give us an idea of when exactly it'll come out. They did say that U.S. English versions of Apple Intelligence will start to roll out as a software update next month, and then they'll start adding other languages, whether that's Chinese, French, Japanese, in the new year. But I think what a lot of people wanted to know was, when are we going to get all of those features? Is this going to be something that is a slow roll, or are we going to get them right away? And I think it's going to be that kind of slow roll cadence. Whether or not that placates Wall Street, which is banking on this as being a new catalyst for sales, that kind of remains to be seen.
All right, Dan. Thank you. Appreciate it. Apple having its much anticipated iPhone 16 event today, but how much do iPhone sales make up Apple's total revenue? Yahoo Finance's Julie Hyman joins me now with a closer look.
The short answer is a lot. Apple is still quite reliant on that Apple iPhone revenue. It's also a profitable product and high margin, particularly with these newer, higher margin phones. So if you look at the iPhone revenue through the years here, you go all the way back to 2014, it was right around $100 billion. Now in 2023, that had just about doubled to $200.6 billion. And as you can see, there have been ups and downs some years. In fact, we saw a bit of a decline last year in that iPhone revenue. But if you look at it relative to overall, it's remained pretty consistently at least around half of Apple's overall revenue. It peaked, by the way, at about 66%. That was back in 2015, so that was the biggest proportion. Since then, of course, we've seen Apple introduce new products like the watch, for example, and of course, beef up its services business as well. So that now makes up a much larger proportion. Now, as to whether this new iPhone 16 is going to be a big driver of revenue and profitability, for that matter, we talked earlier to Ben Beharin about that, and he thinks this will power a refresh cycle.
The base iPhone 16 is probably the best base iPhone they've ever made, which could actually very interestingly lead to a stronger cycle for the base model, where this is actually, we've actually noticed a mix shift the last couple of years to the Pro. And I think if that happens, if this aging base does more opt for iPhone 16, we might see more of that mix shift either go toward iPhone 16, which again is not something we've seen before, and we'll see a stronger sales cycle for that, which again might impact ASPs slightly.
So ASPs, average selling prices, again, so that would help potentially the profitability for Apple and those margins. By the way, overall, analysts are projecting revenue for the full year of $390.4 billion. That would be about a 2% increase over 2023's revenue. And of course, Josh, a lot of that's going to be iPhone sales.
Yeah, it was interesting to hear Ben Beharin talk about, you heard him say that aging base right there, Julian. Just to put a number on that, I was talking to Gene Munster, who, longtime Apple analyst. Munster estimates there are roughly 700 million active iPhones out there that are at least 3 years old, which is just an incredible number. And it's part of the reason Munster, and I think Ben there too, saying some relative optimism, because the bull case in part just resting on, listen, the iPhone 16, so they bet, will be compelling enough to get a lot of those people to upgrade.
Right.
We'll
Well,
see.
and it's whether the Apple Intelligence, that AI offering, is going to be compelling enough. I was just talking to Josh Schaefer about this in the newsroom, this question of whether it will be enough. And I think that at this point, we just don't know the answer to that. When they start rolling this out, it gets in people's hands. Word of mouth starts to spread. Critics come out and review the product, not necessarily the phone, but all of those AI products. Maybe then we'll start to see some traction here, and we'll get a better feel for what demand is going to be like.
Yeah, part of it is, you listen to those Apple executives, and I think part of their job today was to make the case, to really explain to the millions of people, and it really is millions of people who turn into this event, explain, okay, these are these AI features, and really explain to them why they're important, why they're excelling, why you need to upgrade as you said, Julie, we'll have to wait and find out, whether they made their case as effective as they could have.
We shall see.
All right, thank you, Julie. That is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. But stick around for some bonus coverage as we're headed back out to the Goldman Sachs Communacopia and Technology Conference in San Francisco as Madison Mills sits down with AWS CEO Matt Garman. Not going to want to miss that one.
I'm Madison Mills here at the Goldman Sachs 2024 Communacopia and Technology Conference, and I'm joined by the CEO of Amazon Web Services, Matt Garman. Matt, thanks so much for making time for us right off the stage.
Yeah, happy to be here. Thanks for having me.
Of course. So we've got some big news from AWS that I want to start with. You just announced this partnership with Oracle, and I'm fascinated in this because historically Amazon has not always been the most bullish on Oracle, previously a little bit more of a competitive relationship. What did Oracle change?
Well, look, we've always wanted to have a broad set of offerings for customers. And so we've actually offered Oracle in AWS for the last decade plus. And you can run Oracle on RDS and have for the last 10 years. And so part of it was Oracle's willingness to partner with us. And we really sat down with them. And what we really thought about was how do we bring the best of AWS together with Oracle databases, where customers do like running on Oracle databases, and they're quite good for a variety of use cases. And so we sat down with the team and thought of how do we deliver a product that would be unique and interesting and bring that value. And so the teams really opened up, and they thought about how integrating backups into S3 could work. We thought about how integrating AI services into Oracle databases would work. We thought about how zero ETL could work so that customers can seamlessly use their Oracle database running inside an AWS environment with low latency, but actually use that data to do analytics inside of Redshift or other services. And the Oracle team was open to that. And so that is what really kind of helped us open up that partnership and think about how do we go deliver something that's unique for customers that that actually delivers that value. And I think it took us a while to get there, but I do think it's a partnership that strongly benefits customers. And so that's something that's good for AWS, it's good for Oracle, and we're both really excited about it.
And we'll talk about more of the partnerships you all have, but I do want to talk about the conference that we are at, the Goldman Tech Conference. And Goldman released a list of its top AI plays ahead of the event. They had 9 names. Amazon was not on the list, but I'm curious, is the AI strategy from Amazon, is that a feature or a bug that it's not necessarily being listed as the top AI name in this space? Is it something where you all are kind of offering a lot of different competitive LLMs to customers instead of going full force on your own?
Yeah. So when we think about what customers want to do when they really think about AI, they want to get value out of that in their applications. And our end customers are customers of all sides. They're enterprises, they're startups, they're governments. And when the kind of generative AI wave happened, we took a step back and said, how do customers really want to get value out of that? They want a really secure infrastructure. They have to worry about low cost. They want all of the best capabilities that are possible. And so then we went about and built an enterprise platform for customers to really drive AI into their applications. And what that means is it's not just one model. It's not just one feature. It's not just one particular application. It's a platform where you can use all of those capabilities, all of those models, and customers are going to want to use all of them and oftentimes multiple of them together. And so we had this vision from the very beginning about how do you build a platform that helps people go and build interesting AI applications on top of AWS. And so that is how we're very excited about that. Now, some of that means that we partner on many of those models, and customers love using Anthropic models, which are today the best performing models out there in the world. And I believe Dario is speaking at this conference, and they're a fantastic partner of ours. And many customers like to use their models, but customers also like to mix and match. They like to take those models and then sometimes use Llama, open source models from Meta, and combine them together in interesting ways. And sometimes customers will use small models. Actually, a very popular model is an Amazon model around embeddings, where customers apply that to their data to better label it and use their data as part of their RAG index. And so there's a lot of those capabilities that customers are going to want to combine together. And our view is building Bedrock as a platform to help use all of those capabilities together at all parts of that stack. And sometimes it's data labeling, like from startups like Scale AI. Some of it's the models, like an Anthropic. Some of it's chaining some of those things together, like LangChain and other capabilities like that. There's a lot of those pieces that customers want to use, and we want to make sure that they can use all of those inside of the AWS environment and run it in their cloud environment and take advantage of the data that's living in AWS. And so that's how we approach that. We're also building AI into our own applications, into our own capabilities, but our focus is how do we help customers get the most value out of the applications that they're building.
Talk to me about the strategy when it comes to your in-house large language models. Some competitors in the space have been very proactive on having a first-party LLM, like Google with Gemini, for example. What is your thinking on that strategically for Amazon?
Yeah, look, we also build our own models, and that's something that we're working on, and I would say that there's more to come there. But I think that again, there's not going to be one model that's going to rule them all, and I think that is a very different strategy than our other competitors started with. We started from this position of there's going to be a bunch of models here, and some of them will be built by Amazon, some of them will be built by other providers out there, and we want customers to be able to pick from the very best models that are available out there in the market today. And so if you start with that view that there's going to be lots of models, that it's not just my model, it actually really enables the partner ecosystem to get excited about building and innovating on your platform, because they know that they have just as much ability to go win business as you do. If you're very focused on only your first party models and nothing else is there, then maybe you can use other ones if you have to. That's a very different position for your partners than starting from, hey, there's a bunch of models, come and pick the best one. And so we're kind of partner first on that front, and it doesn't mean that we won't have our own, because we do have our own models. But that partner first focus allows us to really have that open platform, and we're seeing the customers like that. They like the ability to always choose what's the best performing model out there. And I think in the world today where it's such a fast-moving technology, the best model today may not be the best model tomorrow. And so if you put all your chips on, this is the one model that I'm going to bet all of my business on, you're kind of stuck if it's no longer the best model. But if you have a platform that has a bunch of models available, it's actually relatively easy to take advantage of new ones or add new capabilities from other providers as they come along. And that's the strategy that we've adopted.
More broadly, the ROI on AI has been a huge topic this earnings cycle for investors. I'm curious, what kind of revenue are you projecting that AWS could be getting coming in from AI specifically for your own business?
Yeah, I mean, we see the AI business growing very rapidly, and it's already a multi-billion-dollar business for us. And it's continuing to grow very well. And so I think for our perspective, we are fortunate that we make money in a number of different ways, whether it's from selling models, but also from the infrastructure of providers training large models on top of us. And so there's a bunch of those pieces where we can go monetize those. I think over time, this is a technology that has such huge potential to deliver massive gains for enterprises and for startups and customers of all size that I think the payout for us is it's very similar to our existing business, really. We go invest in infrastructure, we invest in compute, we invest in databases, we invest in technology, and then customers come and they pay us by the hour for it. And so in many ways for us, the model is not all that different than the core cloud model. It's a different use case, it's growing really rapidly, but it's a model that kind of how we've built the business up to a $105 billion run rate that we're at today.
And I hear what you're saying about offering customers this idea of choice. But it's fascinating, the conversations I've had with analysts even here today, there seems to be this undertone of an idea that Amazon is behind when it comes to generative AI, that Microsoft has the first mover advantage. How worried are you about that? Is that a concern for you, that perception?
Yeah, well, I mean, I would be worried if I was, it's a partnership for them, by the way. It's not their own technology. And so that is an interesting struggle for Microsoft that they're also going to have to deal with, which is it's not their own technology. And there's actually, interestingly, in their last earnings announcement, I believe OpenAI was listed as a competitor of theirs, which is an interesting dynamic for them. But we like to partner, not necessarily compete. But I think, look, we're at Amazon. We have a saying that we're willing to be misunderstood for long periods of time. And for us, we felt that it was more important to actually build a baseline platform that customers could really go build real enterprise value into their applications on, as opposed to rushing in and quickly getting out chatbot technology that could, looks cool and allows people to write haikus and other things like that. But, that's not really the eventual place that the value is going to come from this technology. It's not just chatbots. And so I think a lot of others were quick to go out there. And by the way, OpenAI has great technology, so they have really good models. But there's a lot of other pieces out there. And I think the more you can be industry specific and understand how you help customers solve specific problems, the more you have a platform to help customers build really good RAG indexes like we have with knowledge bases, or build agents into your AI so that you can actually go and execute on various different capabilities. The more you can have some of these other pieces that are not just the model. I think the model is the first thing that the world has built, and now you're seeing a lot of these other capabilities. And that's why we're actually seeing, so Bedrock, which is that platform for us, is a really, really rapidly growing business for us. And I'm quite bullish that inference, which is really the piece of AI where the enterprises go and actually build it into their application, customers are going to want to build that on the platform where they have their applications running. And so we're increasingly seeing more and more customers use the Bedrock platform to actually go build real applications into their actual enterprise applications. And so it's okay. You guys can you can say what you like, but it's I think that taking a step back, thinking about what customers are really going to want over the long term, and taking the time to build that secure, great platform is going to be great for our customers, and I think we're already seeing that business really start to accelerate.
And you mentioned your chips business, so let's talk about chips. I'm just curious, in terms of your own LLM, what is your current usage ratio-wise of NVIDIA chips versus your own in-house chips for training?
Well, look, we don't share that specifically, but if you talk to customers out there, still the large majority of usage is on NVIDIA chips, and they have a great platform, and they're very popular with customers. That said, we think that it's a really large market segment, and there's a ton of potential for multiple options. And so customer choice is super important, and we're seeing, I would say, an accelerating pace of customers getting excited about both Trainium and Inferentia, which is our custom processors. And so Inferentia is the chip that's specifically built for AI inference. And that's now been on the market for about 4 or 5 years. And we're increasingly see customers use that. Particularly, it's really valuable for a couple of different use cases where there's small inference that needs to be done, where customers can really save cost. And we see sometimes customers save 60, 70% off of their inference bills when they move to Inferentia. And we're increasingly seeing really larger and larger customers do that move. On the training side, we're on our first generation of Trainium. And so a lot of the work that we've done over the last year or two is to get the software stack in a place where it can be really powerful for building some of these really large models. And so that's where we've seen a lot of the market and customer base progress over the last year or two. And we have customers like Ninja Tech who built their entire model all on Trainium, and they're super excited about that platform. And we have Trainium 2 that'll be launching by the end of this year. And that is a platform that we feel incredibly excited about for really large training clusters where customers can get outsized price performance gains relative to the traditional platforms that they've been using around Nvidia. Now, that being said, we think that there is going to be a mix of use cases for a long period of time. And we support Intel, we support AMD, and we have our own general purpose processors called Graviton, but we also support Nvidia GPUs, and we're going to support Trainium and Inferentia. And we think that there's a really large market segment, and there's room enough for customers to be using the best product for the use case for a long time.
But given the price point of NVIDIA chips, wouldn't it be beneficial for you to continue to rely on your own chips more and more over time versus?
We think so. And we think it is for us and for customers both.
So how long until you're fully reliant on your own AWS chips?
Like I said, I actually think there's going to be use cases for both over time. So I don't know that we'll ever be fully reliant on them, because I think that the NVIDIA team builds some great processors and some great products, and they execute really well. So I think there's going to be use cases where NVIDIA GPUs are the best solution for a really long time. And we're going to push really hard to open up and have more and more and more of those served really well by Trainium.
I want to end on the cloud business because we're running out of time here, but obviously you've been with AWS since the beginning, kind of part of the founding of that cloud business, and AWS is the market leader in that space, but you still have anywhere from 80 to 85% of workloads running on premises instead of on the cloud. What's the strategy for getting more of that data onto the cloud?
Yeah. Well, look, I think it's a big opportunity for lots of customers. We see whenever customers make that move and they move from an on-premise world into the cloud in AWS, we see their innovation moves more quickly. We see them increase the agility of their organization, and we actually see customers reduce costs and just move faster over time for their business. And so there's a huge amount of value there. When you layer AI on top, you can take the very best AI models in the world, and if you point them at an on-prem mainframe, you don't get very good results because there's just not much you can actually do when you access that data. The more we talk to customers, they realize that if they can move their data from these data islands when they're on-prem, whether they're mainframes or databases, and move all of those into the cloud so that they're accessible and labeled in a way that they can actually get value from all of those sources of data, that move to the cloud is really what unlocks that value. And I think AI is one of those things that's going to encourage people to do that faster. But there's a huge potential out there for us to help customers on that journey as they continue that move.
And finally, really quickly here, you mentioned on the main stage just now that most of your customers are not interested in building their own large language models, but they are going to play in AI. Yeah. How does that impact AWS's business moving forward?
Well, it's just, if you think about it, most customers don't build their own database either, or most customers don't, build those core kind of capabilities. And so there's going to be a few providers out there, OpenAI and Anthropic and Amazon and Google and Meta and others that are going to build these large foundational models. And then customers are going to use those. And our view is a lot of customers are going to modify those. They're going to add data to those and do kind of post-training runs. They're going to distill the models down to be very specific to their use cases. They're going to combine them in different interesting ways and use them in their applications. So they'll use those models, but a lot of people will use those core foundational models as those building blocks.
Matt Garman, AWS CEO, thank you for making the time for us. Really appreciate it.
Thanks for having me.
That's it for our coverage today from Yahoo Finance. Thanks for watching.